Let me tell you about a trader I know. He had a $50,000 funded account, real money, real rules, a 10% profit target, meaning he needed to make $5,000 to pass the evaluation. His maximum drawdown was 10%, which meant he could not lose more than $5,000 total before they shut him down. And his daily loss limit was 5%. $2,500 in a single day was the end of his session, no exceptions. On paper, those numbers look manageable. In practice, they destroyed him the first time and the second time, and it wasn't because the rules were too tight, it was because he didn't have a plan that fit inside those rules. He had a strategy, he didn't have a business. So let's talk about what a business looks like on a $50,000 account, not theory. Steps. Step 1. Know your numbers before you place a single trade. On a $50,000 account, 1% risk per trade is $500. That is your unit. Every trade you take, you are risking $500, no more. Not because you're being cautious, because that is the math that keeps you alive long enough to win. Here's why it matters. Your maximum drawdown is $5,000. That means if you risk 1% per trade, you can have 10 consecutive losing trades before you're out. 10. And if your model is sound, you will not lose 10 in a row. But if you're risking 3 or 4% a trade, trying to accelerate your profit target, 3 bad trades and you're already at 30 to 40% of your total drawdown. The pressure that creates changes how you trade. You start overriding your rules. You start chasing, and that's when the account dies. 1%, $500. That is your unit. Write it on a card and put it next to your screen. Step 2. Build your profit target backwards, not forwards. Your target is $5,000, 10% of the account. Most traders look at that number and think about how fast they can get there. That's the wrong direction. Instead, ask yourself, how many clean, rule-based trades do I need to take at 1% risk with a 2-to-1 reward-to-risk ratio to reach $5,000? At a 2-to-1 ratio, each winning trade makes you $1,000. You need 5 winning trades to hit your target, if every trade wins. In reality, if your win rate is 50%, you need roughly 10 to 15 trades. That's it. 10 to 15 good trades over the course of a challenge period. Not 10 trades a day, 10 to 15 total. When you frame it that way, the urgency disappears. You're not in a race, you're executing a process. And suddenly, passing the challenge feels less like gambling and more like showing up to work. Step 3. Pick one session and protect it like it's your only source of income. Because right now, it is. You cannot trade every session and pass a funded challenge consistently. It is not possible. Not because the setups aren't there, because your discipline cannot sustain that level of exposure, and your account rules punish overtrading more than anything else. For a $50,000 account, the London session between 2 a.m. and 4 a.m. New York local time gives you one of the cleanest, so most structurally defined windows in all of price action. 2 hours, 1 or 2 setups. That's the entire plan. Every clock at your desk needs to show New York time. Everything runs on New York time. It doesn't matter where you are in the world. Set the clock and submit to it. Step 4. Do your homework the night before, not in the moment. Before London opens, you need to know 2 things: what the weekly chart is telling you and what yesterday's range was. The weekly chart gives you your bias. Is the current weekly candle likely to expand higher or lower? You're not guessing randomly. You're looking at where the market closed last week, where it opened this week, and whether there's an obvious draw, an area of inefficiency, or a pool of stops, that price is likely to reach. That becomes your directional bias for the week. Bullish or bearish. One direction. You are not trading both sides. The daily chart gives you your reference range. Write down yesterday's high and yesterday's low. On a $50,000 account, these 2 prices are your most important numbers after your risk parameters. Everything that happens in London will be measured against them. If your weekly bias is bearish, you want to see yesterday's candle close up. That sets the trap perfectly. And you want to see the current price at 2 a.m. sitting below yesterday's low. That tells you the market has already broken down. The move is already in motion. Now you wait for the setup inside the structure. Step 5. Identify your ambush zone before the session opens. Inside yesterday's range, specifically in the lower third or lower quarter of that range, you're looking for a level. A single prominent high or 2 to 3 candles that hit roughly the same high. These are relative equal highs. On a 15-minute chart, they're easy to spot. On a 5-minute chart, they're even clearer. Those equal highs are not random. They represent buy stops, resting orders from traders who are short and place their stops just above those highs. The market sees those stops. The algorithm targets them. In our $50,000 example, let's say yesterday's range was from 1200 to 1280 on the S&P futures, an 80-point range. The lower quarter of that range sits between 1200 and 1220. If there are relative equal highs at 1212, that is your level. That is where you're watching. You are not watching price. You are watching that level. There is a difference. Watching price means you react to every candle. Watching a level means you wait for price to come to you. Step 6. Wait for the Judas swing and let it complete before you do anything. Between 2 a.m. and 4 a.m., if your setup is in place, you will see price push up toward those relative equal highs. It will feel like a breakout. It will look convincing. Volume will pick up. Retail traders will start buying. And that is exactly when you do nothing. You wait. You wait for price to run above those equal highs, to sweep the buy stop sitting above them. And then you wait for a rejection, a sharp reversal candle, a move back below the level it just swept. That confirmation, that shift in momentum after the stop run, is your entry signal. Not before. After. This is the hardest part, not the analysis, the waiting. Because London moves fast. When it sweeps those highs and starts to reverse, your instinct is to second guess it. It moves so fast. What if it keeps going? What if this is the real breakout? Here is the answer to that question. Your bias is bearish. Your weekly chart said down. Your daily chart set the structure. The equal highs were in the lower portion of yesterday's range, exactly where the setup should form. The sweep happened exactly where you anticipated it. There is no ambiguity. You take the trade. Step 7. Size your trade to protect the account, not to accelerate the target. On a $50,000 account, your stop is placed above the high that was just swept, a few points above the wick. Let's say that's a 10-point stop on the S&P. Each point on a standard ES contract is $50. A 10-point stop on one contract is $500. That is exactly your 1% risk. One contract, one clean stop, $500 at risk. Your target is 2 times your stop, 20 points lower, $1,000 on the trade, 2% gain on the account from a single setup. You need 5 of these to pass the challenge. 5 clean trades, not 50, not 20, 5 if they all win, maybe 12 to 15 if you account for losses. That is the entire challenge distilled into a number you can actually work with. Do not add a second contract because the trade feels good. Do not move your stop because the trade is uncomfortable. Do not close early because someone on social media posted a bearish headline. You placed the trade according to your model. You let your model finish its work. Step 8. Log every trade the same day, win or lose. After each session, before you do anything else, write down what you saw, what you did, and why. Not a paragraph, a record. Entry time, entry price, stop level, target level, result, and 1 sentence about whether you followed your rules. This log is not for reflection, it is for accountability. Because on a $50,000 account, the difference between passing and failing is not usually one bad trade. It is a pattern of small deviations. Exiting early here, sizing up there, taking a trade outside your session window because you were bored, that accumulates over time into a blown account. The log shows you the pattern before it costs you the account. Review it every Sunday? Not to judge yourself, to identify what is drifting. Step 9. Treat your daily loss limit like a hard wall, not a warning sign. Your daily loss limit is $2,500, 5% of the $50,000 account. If you hit that number, you stop trading for the day. Not because the rules say so, because the rules exist for a reason. The days you are most likely to blow past your daily limit are the days you've already had 1 or 2 losses and you're trying to recover. That impulse, the need to win it back before the session ends, is the single most destructive force in funded account trading. It bypasses your model. It bypasses your risk rules. It bypasses everything you built. If you take 2 losing trades in London and you're down $1,000, you are still well inside your daily limit. The model worked as designed. Losses are part of the model. You close your platform. You come back tomorrow. And that discipline, repeated consistently, is what separates funded traders who last from funded traders who reset. Step 10. Understand that passing the challenge is not the finish line. The day you get funded is the day the real work begins, because now the same rules apply. 10% profit target, 10% max drawdown, 5% daily limit. But the psychological weight is different. It's real money now, real payouts, real consequences. The trader I told you about at the beginning, after he blew his first funded account, he went back to demo, not to practice setups, to practice discipline. He ran the same $50,000 account parameters on demo for 60 days. Same session, same 1% risk, same log. And he tracked his performance as if it was real money, because mentally he needed to treat it that way. When he got funded again, nothing felt new. The process was already his. He wasn't learning to follow the rules under pressure. He had already built the habit of following them in the quiet, before the pressure arrived. 3 months into his second funded account, he requested his first payout. Not because he was in a rush, because his rules said to scale out at a certain profit level, and that level had been reached. That is what this process looks like when it works. Not dramatic, not a viral screenshot. Just a trader who understood his numbers, controlled his session, followed his model, and let time do what time does when you stop getting in its way. The $50,000 account is not the obstacle. Your relationship with your own rules is the obstacle. Fix that, and the account takes care of itself. You already have more than you think. What you need now is the discipline to use it. If this helped you, smash that like button. Your future funded account will thank you. Subscribe so you don't miss the next one, because clearly you have good taste. And drop a comment below telling me where you're at on your prop firm journey. Whether you're on attempt number 1 or attempt number 7, no judgment, we've all been there. All right, go get some sleep. London opens at 2 a.m.